Thank you for joining us. My name is Hiba Khan, and I'll be managing this breakout discussion. Before we begin, a quick reminder to submit questions via the Whova app. So if you click the session, select Q&A, you can also upvote questions and also submit your questions there. Carbon markets are playing a growing role in corporate climate strategies, but they also sit at the center of a key tension: how to move quickly while ensuring integrity and real impact. Today's session will explore when carbon markets can drive meaningful decarbonization and how leaders can navigate trade-offs around data, standards, cost, and credibility in an evolving system. Moderating this session is Florian Berg, Principal Research Scientist at MIT Sloan, where he co-leads the Aggregate Confusion Project. His research focuses on ESG measurement, carbon accounting, and voluntary carbon markets, and has been featured in outlets including the Financial Times and the Wall Street Journal. Please join me in welcoming Florian and our panel.
Thank you. Thank you. Yeah, I will be your host for this panel. We also, just to add to this, we started actually a new project, the Catalytic Climate Finance Project, which will really focus on the voluntary carbon market, but also on environmental attribute certificates, EACs, the new hot topic in the space, and we will touch briefly up on this later in half an hour. But for now, let me introduce you to our panelists. We have Tim Kenny, who is the CEO at Global Emissionary, and he joins us from Naples, Florida today. So thanks, Tim. We have Evan Deutsch, who is the Chief Commercial Officer at Restoration Climate, and he joins us from Boston area. We also were supposed to have someone else, Jacob Friedman, but he couldn't make it because his flight got canceled last minute. He booked a flight with Lufthansa and they are on strike. So, but so more time for our two panelists. Okay, Tim, can you just briefly introduce yourself and your role at Global Emissionary?
Yeah, absolutely. Is my mic working? Okay. Good. So, yeah, good to be here with everybody. It's great to see all of the young energy this week, which is, just so important as we move forward in what we're trying to do with emissions. It's really going to be amongst you guys to lead the charge. So, I work as the CEO of Global.
My name is Nirmal Kumar, and I'll be managing this.
Should I just talk over that? Should I keep talking? Okay.
Yeah.
All right. So I work as the CEO of Global Emissionary. We focused on the built environment. So as opposed to nature-based credits, ours is more of a science-based, engineered type of credit. Specifically, a lot of our focus is going to be in the asphalt sector. We have a long history from our founder of building roads. Starting in the late 90s and early 2000s, we pioneered certain techniques to actually recycle a road in place without using hot mix asphalt, which is a very carbon-intensive process where you mine virgin aggregate, transport it to a hot mix plant, create the hot mix asphalt, and then you lay the road down. So we saw the benefits of this. And then starting in 2012, we started to develop a carbon methodology. That was approved in 2019 by Verra. It's known as VM0039. We are the authors of that methodology. And then we began to build this technique out. So starting in 2022, we piloted our first projects in the United States. Fast forward to today, we're working in 24 of the 50 US states. We've done over 5,000 lane miles where we've recycled roadways, and we've saved close to 500,000 tons of emissions thus far by doing so. And we do take the credit and we sell those to large companies who wish to offset their emissions. So we'll probably dive into a little bit more of this as we go, but carbon offsets and purchasing carbon offsets are also secondary. First, a lot of these companies that we do work with, they're going to first decarbonize from within, and then eventually for harder to abate emissions, they will go ahead and purchase offsets from companies such as ours. So large companies such as Airbnb and Etsy are two of our bigger customers. So.
Oh, great. Thanks, Tim. Evan, so what did bring you to the carbon markets?
Sure, absolutely. So first of all, I was a student at ClimateCAP at Kellogg a handful of years ago. So it's cool to be back. Good to see it still running stronger than ever, it looks like. And we also definitely did not have any type of carbon market specific content a handful of years ago. So I'm excited that there's so many of you here. So thanks for joining. What brought me to the carbon markets? I knew I wanted to work in climate. Post Kellogg, I was interested in potentially ClimateCAP VC or operating, and I had an opportunity to join a company called Flow Carbon, which is actually a little bit infamous. Folks probably don't know it at this point, but it was one of Adam Newman's startups, and this is 5 years ago when people thought it was a good idea to tokenize carbon credits. As if the market isn't challenging enough. And so that's actually what brought me in. I joined that team leading their commercial efforts, and the market was actually really hot at that time. So I think it sort of masked a lot of mistakes and sort of structural instabilities in the market that I'm sure we'll touch upon have been exposed as the market has grown up in the last 5 years. So that was my foray. I was a few years at another shop called Viridios Capital, where I was not just on the commercial side, but also investing into projects around the world, primarily focused on US buyers and primarily focused on the voluntary markets. We also had a pretty active trading desk that operated in the Australian compliance markets. And I have been with Restoration Climate now for a couple years. I lead our commercial efforts there, but it's a relatively small team, so I wear a lot of hats, and we are a carbon, but also other environmental commodities investment sales and trading company. So carbon is definitely our primary focus at the moment, and we're specifically focused on, this term means different things to different people, but the convergence of voluntary and compliance markets and where they intersect. So we'll definitely speak more on that, but that's where I'm focused.
Great, thank you so much. Let's take a little bit a step back. Who has heard or who knows what a carbon credit is? Everyone. Okay, that's great. So that's perfect. I would still, maybe for those who, have you ever heard of those trust issues in the voluntary carbon market actually? Yeah, okay, that's great. Perfect. Then my next question will be for Tim. Can you actually walk us through a little bit through this project that you developed of issuing carbon offset carbon credits from the planning phase when you had the idea and how integral it is to your company to registering it? You already mentioned Vera as a big registry, and then to selling actually the credits.
Yeah. Yeah, and I think the first thing I would do is just a very simplified definition of a carbon credit, right? Because it does get complicated. The easiest way to think about this is you identify an emissions-heavy baseline, which in our case would be a hot mix asphalt. It's one of the most heavily produced substances, nearly 2 billion tons a year of hot mix asphalt. You look at it and you say, okay, well, this is a heavy emission sector. It needs to be abated. So at that point, you introduce a low carbon intensive alternative. In our case, we say, we're going to figure out a way to recycle this road. Instead of having to mine virgin aggregate, how do we recycle this in place and reuse the material? What we do accounts for less than 2% of the way roads are built at the present moment. We'll get into scale, and that is the point of carbon finance. So the goal is to increase that over time. So what you do is you take the emissions-heavy baseline, you introduce the low-carbon alternative, and then you measure the difference in total carbon emissions. You do that internally. Then you go ahead and you get it verified by a third party. That's both a registry, and they require rating agencies, validation verification bodies, they're called VVBs, to verify the credit. Once that is done, the credit is issued, and it can be sold to a company who wishes to offset their emissions. So, traditional asphalt is very carbon intensive. We work to both recycle it, and some of our newer work too is incorporating bio-based binders and lower carbon alternatives such as biochar into the asphalt as well to bring down the total carbon footprint of the road. Our goal right now, as we move towards our previous credit, where we've done a lot of work in the last 5 or 6 years, creating an avoidance credit that we've done a great job of marketing that to different organizations, is we're moving into a removal credit now with incorporating biochar into the roadway. And it's a very specific construction grade biochar where, at a great scale, we can put a lot of this and bury it into the roadways of both the United States. It's actually been done overseas as well, more popular done overseas, but the specs to get it into US roadways and to get it into the DOTs, the State Department of Transportation's, much more laborious here, as you guys can imagine, in the US. So we are working on that as we speak. Right now, we're at a very pivotal time. We're doing our first 7 projects in Louisiana in the months of May and June, where we're incorporating this special biochar into private roadways, and we'll develop removal credits from that. So
That's great. That's a good project. Can you? I think why do you actually move from to removal? Is there any particular reason why you actually decided to incorporate biochar?
Yeah, the market has shifted a lot in the voluntary carbon market in the last, we'll say, 5 years. I'm sure many of you have read about this, 21 to 22, and Guardian came out with a very popular news story that was really troublesome to the VCM. It was a little bit more into the nature-based space, and happy to speak on that a little bit. But but ultimately, that stuff happens for the good. It put a lot more scrutiny on the market. It brought forth the ICVCM, which has come forward now with new standards. It brought forth the the growth of rating agencies, which now back a lot of the carbon projects. The CCP, which has now come up, and now they look and work with the rating agencies to certify a project with a core carbon principle, which is the CCP acronym. So it was very challenging at the time. It put a lot of hurt on the carbon market. But ultimately, what you're seeing right now is a reemergence of that market with more transparency. And that's allowing the buyers to discern quality in the credits much more.
Yeah, thank you so much. Yeah. This is great. So this was a little bit the view from a project developer, and now we will actually speak from the view of someone who actually trades those instruments. So Evan, can you tell us a little bit how actually those markets as financial markets work?
Absolutely. So I think off the bat, important to distinguish between the compliance and voluntary markets. So California cap and trade is probably the best known one, certainly in the US. European ETS, there's a UK market. Those two markets are converging. There are a number of markets, of compliance markets in Asia. China has an ETS is emissions trading system, scheme. So it can manifest in different ways how they actually structure the carbon pricing mechanism. California is a cap and trade. Those allowances are basically granted by the government to heavy emitters, and if you come in below your cap, you can sell, and vice versa. There are other details related to auctions and a bunch of intermediaries and speculators in the middle that will broker those deals and speculate on the price of the allowance. But generally speaking, it's important to distinguish because those are regulated, pretty liquid, less volatile markets, right? They're either at a state level or a regional level. We have the Regional Greenhouse Gas Initiative in New England, or at a federal level, right? So on the other side, you have the voluntary carbon market, and people have called it the Wild West. I think that's, I think it's growing out of that stage, but there was certainly, a stage where anyone was minting credits and issuing them and taking them to market, and people were buying. Like there was just no self-governance of the market. And today, it's grown up quite a lot. So, as Tim explained, there's the developer, which is really the beginning of the value chain, right? So they collaborate with a project proponent, often some form of investor, unless they're self-funded, to develop the project, to run a feasibility study, to actually validate and verify the project to the point where they can generate and sell the credits. From there, how those credits are transacted is highly variable. So as Tim said, more savvy developers that have connections and a sales force can actually sell directly to end buyers, and those are large corporates, banks, consulting firms. We're really seeing it cross-sector now. And so in that instance, it's a bilateral over-the-counter trade, right? Money for a credit. Like most other markets, a lot of the volume runs through intermediaries, so that's where we sit in the market. So you have brokers, right, that are basically just matching buyer and seller and taking a 5 cent per ton margin on that. You have traders, so we actually take risks, so we will do back-to-back deals like that, but we are also speculating. We're a long-term off-taker, so we will take a 3 to 5 year view on the market, build a portfolio of credits that we believe will appreciate in that time, and resell them to end buyers. And there's often, many steps in between. It can, I've seen credits that run from one of our projects to a broker. We buy it back and sell it to somebody else. So it's, it's definitely a pretty fragmented market today. And there are also exchanges, right? So we're seeing like there's CIX, there's Expansive. There are a number of different exchanges where these commodities are actually basically traded like ETFs, right? So those are liquid cleared trades. And I think what you hear a lot in the headlines, what's really important, and I'm sure you can speak to this, Tim, is the forward contract, the forward offtake agreement. Because that type of agreement, which we'll talk about Microsoft, but they're, in terms of carbon removal, far and away the largest offtaker. That's just a commitment to buy a certain number of tons for a certain period of time. So you might say, I'll buy 1 million tons a year for the next 5 years, typically at a small escalating, slight escalation in price. And that's really important because that capital, that prepayment, is what the developer actually uses to develop the project at the quality standard that's now expected. So I'll pause there.
No, well, that's great.
Yeah.
That was very interesting.
Yeah, I could add a couple things
please.
to this too. One is price. What is the price of carbon, right? This is a major question, right? Because you guys, if you look, the cap and trade system has more regulated pricing. So you'll see California upwards of upper $30 per ton, right? Mm-hmm. Washington State is a relatively new compliance market with some constraints right now on supply. I think the price has creeped up around $60 a ton. But in that general vicinity. Now, the voluntary carbon market is a wild swing. We can have all the way down from $1 or $2 per ton up to, I saw some questions about, Microsoft, who purchases CDR, carbon dioxide removal, from DAC, which is direct air capture. I don't want to use too many acronyms here. DAC, where you actually pull carbon out of the air, and Microsoft paying upwards of $300 plus per ton, right? So this is certainly not commoditized yet, right? This is not, rice doesn't trade for between $2 and $300 a ton. So it's very confusing. And that's where you have coming in, what is the quality? What is the quality of the credit? You have two different types of credit, either a removal credit, which we've touched on a little bit, and avoidance credits. And avoidance credits are going to go from the lower dollars, $2, $3, $4, $5 a ton, up to maybe low 20s per ton, kind of in that market. The removal is considered the more impactful credit. The appetite from buyers right now is more for removal credits, and those can go from $100 to $300 a ton. But ultimately, I do believe that the voluntary market needs to shift more to some sort of compliance market, something that is more of a commoditized price of carbon, where as an emitter, if you are putting 1 ton of carbon up into the atmosphere, what does that cost your company? You shouldn't be able to come in as a major gas manufacturer, not to call them out or anything, but you shouldn't be able to just buy the cheapest possible offset for $1 or $2 a ton and call yourself carbon neutral. And that's kind of, again, the wild, wild west that we were at a couple years ago, where we've morphed into. But I'll just add the final thing on this specific topic is that often these unique technologies, they're not cost competitive with the baseline business as usual, right? So it costs more to do something until you reach scale, right? We hear that word oh so often. And that is the point of carbon finance, is to bridge that gap. Carbon finance is supposed to come in and say this newer, greener technology is more expensive. It might cost X number of dollars more per whatever unit metric you're using. Carbon finance is going to come in and rescue it at, whether it's $10, $15, $20 per ton. It's going to help to offset this new technology. It's going to grow it. This is what we've done with recycling asphalt, is we're using the carbon finance to invest back into the road work so that eventually this becomes a line item for the contractor, that the contractor knows that we have a 4-year offtake, for example, for all of the roads that they're going to recycle. And for every single bid project they put out there, we want them to know that this is backed by carbon finance, backed by a large corporate who's committed millions of dollars to this process. And for every lane mile that you do, you add in this line item that says you can reduce the cost by whatever that number is, and it's actually factored in. And that's where the carbon markets really come into play and allow these newer technologies to scale with the backed offtake agreements.
Thank you, Tim. Yeah, we studied actually this, the fact that this CO2 is not commoditized on those voluntary carbon markets. And by commoditized, what you meant is that there's a huge price dispersion, as you said, right? Anything between, you said, a couple of cents up to a couple of $100. And so we actually did some statistical analysis, and we found that actually this price dispersion is not only between carbon offsets, but also within the same carbon offsets. They can be traded for vastly different amounts. And the reason what we find in this research is that it's a market that's heavily driven by bias and by buyer preferences, which is very unusual. And those buyer preferences, they go beyond CO2. It's often the story of the project that's really important. So that could be co-benefits, right? Biodiversity benefits. That could also be how much they like a certain technology. And we find also that there are certain technologies that people really don't like. And so even though they have a high certainty of actually reducing or capturing the CO2, they have a very low price. So what do you actually think, Evan? What would be a good way of strengthening this market then? Is there anything we can improve maybe this commoditizing the market? Mm-hmm.
So I think the best example of that, of how to commoditize, is to agree on what is quality, right? Like, how do you define a high quality? Everyone has a different definition of what is a high quality or a high integrity carbon credit. They actually mean two different things, which I won't bore you with, but quality and integrity are actually two distinct technical terms in carbon, believe it or not. But so I think, Tim mentioned the ICVCM, which is one of the basically self-governing bodies within the voluntary carbon market, Integrity Council for Voluntary Carbon Market. And their core carbon principles are I would say on the way to becoming accepted as the standard of quality. And I think for this market to start to scale at a meaningful level, because today, I mean, the voluntary market is maybe a $2 billion market. I think folks often conflate that with the global carbon market, which is actually close to $1 trillion when you factor in all of the carbon pricing mechanisms around the world on a compliance basis. So it's a very small sliver, but it gets an inordinate amount of media coverage. And so, where was it going? CCP, right. So ICVCM, the core carbon principles, these are basically defining what is a good enough ton, right? So that if you're a corporate and you're buying a carbon credit, a voluntary carbon credit, you know that you're not going to end up on the front page of The Guardian for greenwashing, or that you spent $20 million on a project that, you know, their carbon baseline measurements were off, and all of a sudden you are exposed and you have to go back into the market and buy credits at a much higher price, right? So I think for it to grow up, I think that's a really important factor, and I think we're making good progress there. We're also seeing CCP, there's a lot of overlap between the core carbon principles and other basically reporting requirements. So many of you have probably heard of SBTI, which is the Science Based Targets Initiative, and that is more on the demand side. What is the scientifically, you know, optimal way to reduce your emissions over time, to set targets that are aligned with science? Only recently have they actually opened the door for carbon credits to be used in SBTI signatory, which is very important, because in the past, if you have a company, a heavy emitting business, like airlines are always a great example, and I can speak, there's a whole nother airline market for credits, but we're very far from carbon-free commercial flight at this point. So they have unabatable emissions. How do we bridge that gap, as Tim said? And so that's what's exciting to see about SBTI, is there's a lot of overlap in basically what SBTI, the type of credits they will allow a company to use to still be, you know, science to set and fulfill science-based targets, are aligned with CCP. And in fact, there's some talk that they might actually just say CCP is the standard. So it's open, you know, these things go through consultation and various consultation periods for, you know, this one has been open for 18 months at this point, from V1 to V2. And it actually does have pretty massive ramifications on the market. And if you're a developer, you know, you need to know who can buy your credit for what purpose. So yeah, I think we're making progress. I think that quality standard is super important in really scaling. And then I think the other thing, we've seen a lot of improvement in really just technological advancements in how these projects are validated and verified and measured. So, you know, there's a term DMRV, digital measurement, reporting, and verification. And that is how the market got into trouble. Some developers that were overstating their impact, or their carbon baselines were off, right? That has come a long way, so that people can really trust that the carbon yields that they're seeing are accurate. Yeah, I think those are some of the main ones.
Great. So you talked about quality, you talked about integrity, you also talked about increasing demand. I think in my research, I would also add maybe a strengthened price discovery, because prices are very intransparent on that market, and we don't actually know what someone else pays. So I might be willing to pay more for a certain credit, because I don't see that someone else pays actually much less for that credit. And so we also, with the price discovery, maybe then prices should then reflect actually the quality and integrity. And one of the way, because for example, now we don't, so fun fact, our data set is roughly, I think, 20% of the market that we analyzed. But the data provider that gave us the data made us sign a very strict NDA, and we're not even allowed to tell you what data provider we got the data from. And so I think one way of doing that would be, for example, if you trade carbon offsets, then 2 years later you could post them via the registry somewhere. that, for example, would strengthen the price of carbon. Those things exist already elsewhere, and this could be, for example, done.
Yeah, I would just say, just to add in,
Yeah.
just the best way to summarize the last few years is, we're really shifting from cheap tons to trusted tons. That's really the shift that we have seen. So no longer can you just say as a company, I purchased X number of carbon offsets. There's a lot of reporting and rigor, and if you do that, especially with technology nowadays and media, you'll be pushed on it. So, companies are not just investing in the cheapest possible carbon projects. They see where that got them. The worst thing that can happen to a company is like Evan said, you spend $10, $15 million offsetting on the cheapest project, and then all of a sudden you're in the headlines for greenwashing. You might as well have done nothing, right? Because now all of a sudden you have negative connotation, negative rap on your business. So now companies, they want trusted tons. They want something verified. They want it to be backed and to be validated and to know that a third party has looked at this and says that it's quality. And it is helping out the carbon market. We're not seeing that, $2 to $3 per ton as much anymore. That was more of, 2020, 2021, maybe 22. Now the market is coming more into that, $12 to $17 a range, I'd say, for a lot of avoidance credits. The truth of the matter, though, and if you do deep research, you'll see, for true impact, the carbon price needs to be higher than that. Corporates need to be paying, upper 20s to low 30s for the price of carbon. That should be the true value of carbon for emitting into the atmosphere.
But that would be still much below the social cost of carbon.
Yes.
That is in a couple of hundred. So the damage is caused by the carbon, which is in a couple of $100.
A couple $100 a
Yeah.
ton. Yeah.
So that would be then still a very cheap way of reducing or removing those emissions. So you already talked a little bit about, now you talked a little bit about trust, and you also talked about The Guardian. How did you actually perceive that moment when The Guardian started writing about those markets, and what was your impression? What The Guardian got right, and what maybe it got wrong in this debate, in this whole debate?
Yeah. So us specifically, we are not a nature-based project. So in that instance, it helped a little bit of the science behind our project. I think our carbon accounting is a little clearer. Quality and price is really a proxy of a few different things. It's the quality, the rigor of the project, the type of intervention. Is it a nature-based solution or is it an engineered solution? The other ones are going to be permanence, risk, and co-benefits. And then, along with that too comes the term additionality. If you guys have heard that too, that tends to be one of the most used terms when assessing a carbon project. And what that means in very simple terms is, does the project need carbon finance in order to occur, right? If carbon finance were not there to help it, again, to offset the green premium, to give it the catalyst, would it have occurred? And it's a high metric for how a project is rated. So again, we were a little outside of that because we are not a nature-based project. Now with that, the methodology that we created, back in 2019, our methodology was approved, which is light years in the VCM, by the way. That is before the Integrity Council for the Voluntary Carbon Market, before rating agencies even existed. It was, the Wild West area. But with that, our methodology is approved through Verra. And Verra was the biggest highlight on the Guardian article. So with that, our credits were scrutinized a little bit more. This biggest registry, the 800-pound gorilla, the oldest one, the largest one, who had been the most trusted, was really put in the hot seat. And yeah, it definitely affected the market. I think the market went from its peak, which which I think you had mentioned, $2 billion was in 2021 at its peak, and it slashed by nearly 70%. I think in 2023 it had gone down to about a nearly $1 billion, I think maybe $800 million market, and I think it's gradually ticking back up, but overall, yeah, I mean, that had a lot of impact on the market, but again, you have to look at it through the lens of the improvements that have come from it, and where we're getting better with all the things that we're talking about right now, with the rigor that we're now seeing in the carbon market.
Yeah, you touching up on a great next question, and that is actually what is the future drivers of such a demand? So Evan, what do you think actually? Where will you said a little bit already? SBTI had some methodology changes, but where do you really see actually the market going from here?
Yeah. For us, I think it's the convergence of compliance and voluntary. And the easiest example of that, so I alluded to the airline offsetting scheme. It's called CORSIA, and that is a global offsetting mechanism. So there was a pilot phase that ended in 2024. We're now in phase one. Phase one is voluntary to participate as a country, but it is required once you decide you're going to participate, you must participate. Phase two is going to be globally required. And so, we're still waiting to see what the non-compliance penalties are. In fact, even for phase one, right? So if country A is a participant, and how the structure works is, basically if you are an airline that flies from country A to country B, and both of those countries are participating, you are legally required per CORSIA to offset the emissions of that flight. What's exciting about that is, one, it really starts to standardize. If a credit is CORSIA eligible, it's binary, right? There's no question of, how are the baselines measured, and what is the integrity, what is the quality, what is the additionality of this credit? You know that this credit is good enough for compliance usage. This counts against our CORSIA exposure, and I think that that's going to be a major driver. It's an area of high speculation because right now the supply side is pretty constrained around CORSIA. So we're talking about roughly 200 to a quarter billion tons for phase one of CORSIA, and there's really a fraction of that of available CORSIA eligible credits today. So we, for example, we have a position in a project that is expecting CORSIA eligibility, but it doesn't have it yet. That's obviously the risk we take for the upside in that project. But that's one area that particularly excites me in the convergence of compliance and voluntary. The other side is that compliance markets around the world are increasingly allowing carbon credits, so not allowances, but carbon credits generated from projects into those mechanisms. So California is an easy example. If you're a heavy emitter in California and you're subject to the cap and trade, you can use up to, I believe it's 6% of your total emissions profile. You can use carbon offsets. They have to be generated in California for the most part, against your emissions exposure. And some compliance markets are open, meaning that you can import credits from other countries. That's particularly useful in a lot of Europe, where a lot of those countries are not necessarily conducive to carbon projects, right? It's also a net benefit to the exporting countries, which are typically global south, often developing countries where they have a wealth of natural resources. They should be able to monetize those resources in a responsible way. So that's really another exciting part of this market, is the inclusion of project-based credits into compliance markets. Singapore, for example, they allow, I believe it's up to 30% of your emissions can be covered by carbon credits. So what it does is it really starts to democratize the market for reducing your emissions exposure in a compliance setting. And what that does for the carbon markets in general, for developers and intermediaries, is it's a surety of supply. That's like the missing link in this market, however you slice it, has been durable, consistent demand at scale. And when you are now serving a compliance market, you know what that demand will be. Investors can invest, insurers can insure those projects, and developers can develop with confidence. So to me, that convergence is really exciting. And I think that in the next 3 to 5 years, that will be where the biggest growth in this market is driven from.
Very good. And Tim, so how does that actually, where do you actually for your project see the biggest demand drivers, maybe in particular?
Yeah.
Zoom in a little bit.
Yeah, I'd say, Evan hit the nail on the head. We need this more commoditized. We need this needs to go from corporates and companies and large emitters from the nice to have category to a compliance, a necessity for companies. We must do two things. First, we must report all of our emissions. We need to be transparent. We need to say what they are. This is what it costs to make our product. Second, they want to work hard to decarbonize from within. So now that we know what the emissions are, how do we make our product with less emissions? And then for the remainder that you can't internally decarbonize, you need to be able to purchase from a market where there is some sort of governance, where there is compliance, where a carbon price is set. Your competitor can't buy it for $3, but you want to buy better ones, so you buy them for $15 or $20 or whatever that price may be. Mm-hmm. Because at the end of the day, that comes off your bottom line and, profit, and we all know that corporates are trying to seek profit. They have shareholders. So there's a major conflict of interest in a non-commoditized market where you don't know the price of carbon. So the future is definitely this convergence of the regulatory, the compliance market, and the voluntary market. Europe is ahead of this, ahead of us on this. The U.S. is challenging because, we are the United States, but then we have 50 different states. So, each state is coming out with their own program. So that's making it a little bit more challenging. But, California, we've talked about a lot already. Washington State is following. New York has recently introduced. Colorado is coming up. So, you're starting to see this. And, I think there's 3 main drivers to the future. We need the market, corporate net zero commitments. Very important driver. We need more corporates to make this commitment. And also not be afraid to make the commitment due to, pressure from a current administration, right? If we have to be honest, we all know partially that is what is going on right now. The administration right now, at least in the US, is not favorable. They're profit favorable. They're not favorable to making good environmental choices. So corporate net zero commitments. From there, you need governance pressure. So, regulatory pressure to make all corporates disclose their environmental impact. And then from there, investor expectations as well on, what does this look like? What does this market look like? I need to feel confident to invest into this because I see, like Evan said, the 3-4 year offtake that backs this specific project. So, again, I think that's where the future is, and I do think we're going there. But yeah, if I'm being blunt and honest, I think, the current administration is making it challenging. So, we might have to buckle up here for the next, couple of years. But also the harsh truth is that, we all know what the climate goals were for 2030. We know what they were for 2050. And I've been watching these for years, in the hopes that, we're reaching this, 1.5, and we all know, we're very far from this. We're going in the wrong direction. So, to say that we just need to wait it out through another administration is not a good answer. That's not the right answer. So we really need corporates to step up with their net zero commitments now. Is my thoughts. So.
Thanks.
Not
I would
to
just
get too
add,
political
there are a few sort of green shoots that we're very excited about. So on that note, the number of new entrants, so even though some of the quality troubles has resulted in the market not growing at sort of the exponential scale that we had hoped, we have seen a record, by magnitudes, a record number of new entrants into the market. So new buyers in 2025, I think we actually tripled the number of unique buyers in the voluntary carbon market. Even though they're buying small volumes, that's, they're dipping their toe in. That's their first step in becoming a buyer at scale. So that's super exciting. The second is the scale of investment into the market. So investors want to deploy capital when it's cheap, right? You want to be a buyer when others are a seller, and a seller when others are a buyer. And there are a number of investors in the space. We actually see a lot in the Middle East, believe it or not, that we are in talks with, that they know that the pendulum will swing back. It could be a change in administration. It could be continuing climate catastrophes that just bring it front and center to everybody. But it's not going to go away. And I think that, the smart money understands that you'll be penalized if you put it off for 3 years. So there's a significant amount of investment flowing into the space, even if retirements of carbon credits have been flatter than we had hoped. There's a lot of leading indicators that good times are ahead if we can get to it.
I'll just mention one more thing in terms of the difference between the voluntary market and the compliance. And it's just in the name. Compliance is much more strict. You're looking at standard, certain credits that can be accepted. There's geographical limitations. And they tend to move slowly, the compliance markets. I mean, we're seeing that now. Each state slowly adopting new technologies. The VCM is not like that. It is much more capital driven. It's much more of a capitalism type of intervention. And you can be an early stage innovation, an early stage technology that hasn't received approval, for example, from a compliance market, yet it's recognized through, likely a registry who has backed it, who has seen the science. It's been verified and validated by a third-party verification and validation party. You may have taken it a step further and had it rated by a professional rating agency and gotten an A rating stamp on it. And all of a sudden, this new early stage innovation, this new technology, it might only be 6 months old or 12 months old, but it's backed by multiple parties. Now, it's still not yet in a compliance market because that requires governance and more rigor and a whole trading system. But a company might come in and say, hey, that's a voluntary credit. We believe in that technology. That's an incredible technology. We feel this way about some of our road building technology. And you know what? We'll go ahead and back that on the voluntary market instead of feeling like we need the rigor of a compliance market. So there are positives to the VCM, to the voluntary carbon market in terms of being able to launch it quicker and more early stage innovation. And I think the hope is that that's how you test it, and eventually it leads to the compliance market as well.
So when I'm in those discussions about carbon offsets, sometimes people have very strong, or most of the time people have very strong opinions about carbon offsets. And one of them is just that it's just a distraction. We shouldn't even look at them at all. Maybe I can single you out, Evan, to answer that. What should you actually answer to them? And what do you actually, maybe also in a broader perspective, what do you actually see why, given those trust issues, do you still have buyers tapping into the VCM?
Yeah, I think to start, that was part of the issue in the market over the last few years. Is not only were there projects that were overinflating their impact, or in some cases there were human rights abuses, but there were also corporates that were sort of using cheap carbon credits as a get-out-of-jail-free card to not do the hard, expensive, time-intensive work of decarbonizing their operation. and their scope 2 as well, right? So I think I like to think that generally we're past that. It's not to say that some don't treat offsets that way, but I think that many large corporations were exposed for that, for buying bottom of the barrel 50-cent renewable energy credits from projects that they knew were not additional, that, you know, if you are a carbon accountant, that ton is not a ton, right, against your emissions liability. So, you know, to me, I think, say that one more time, the last part of the question.
I think the when someone comes in really and says carbon offsets are a distraction.
Oh, sure.
And
Distraction.
actually, the argument is then that yeah, they will just spend money on carbon offsets,
Right.
and not decarbonize their own scope 1, scope 2, scope 3 emissions, right?
Yeah.
And yeah, I think there's the economic answer where you say you should just put the money where we have the lowest marginal abatement cost, right?
Exactly.
Where the ton of CO2 is the lowest. That would be the economic answer, but then there's also, then no one really decarbonizes their own scope 1 emissions, right?
Yeah.
So what is the...
Right. Yeah. So in part, it's a hedge, right? If you're a corporate with a hard to abate, hard to decarbonize business model, supply chain, value chain, then, you know, if you you need to prepare for the eventuality. A great example is like sustainable aviation fuel, right? SAF. A lot of the airlines for a long time have been talking about how they're getting pretty close to SAF at scale, and they build that into their emissions forecasts and their accounting, right? And it's proven that it's just taking way longer than anyone expected, right? So if you have not purchased or put yourself in a position to purchase carbon offsets, the alternative is doing nothing, right? You can't, the SAF doesn't exist for you to buy today at a scale that is meaningful enough to decarbonize your emissions from flights. If you haven't bought credits, then you've done nothing. So I think that I frankly see it the opposite way, that a lot of corporates that say that carbon credits are a get out of jail free card. I would actually say that they're putting on more risk by doing that, and they're sort of taking the easy way out by not doing both. It's really, the answer is both and. And there was a study a couple of years ago that by and large, the companies that are the largest buyers of carbon credits are also the largest investors in decarbonizing their own supply chains. So I think we're seeing way fewer companies that are actually sort of abusing the intention of a carbon credit. And I think it's really important too, from an investment perspective, that if you're planning for the future, you need to understand what you're going to pay to hit your net zero goals. And you cannot possibly do that across your entire value chain. So that's why we see, why are they buying today? Some are doing it for the marketing value. Others are really hedging against the future price inflation of this market, and they know that whether it's a compliance mechanism that doesn't exist yet, or consumer sentiment, they're going to be pressured one way or another to offset their residual emissions. And if they haven't prepared for that, then they're really at the mercy of the market price at that time. So, yeah.
Thank you. Let's speak a little bit about actually what I perceive is a little bit the new frontier of, and it's very related to carbon offsets, and you already touched a little bit upon it with SAF, and that's EACs, Environmental Attribute Certificates. Has anyone heard of EACs? Oh, that's much less than carbon credits. So it seems that a lot of leaders, companies that had set net zero targets, they have drawn up their plans, how to get there, and so now they start focusing more and more on scope 3 emissions. And so then the big question is, how do I reduce my scope 3 emissions? In particular, for example, if concrete or asphalt is produced at the other end of the country and it doesn't make any sense to ship it to where I want to consume it, right? So the idea is here a book and claim mechanism, where I buy, actually then I want to build a data center, for example, and I buy then the attribute, the green attribute from Florida. No, your company is in Florida?
We're based out of DC.
Okay, but
we
DC,
do work
yeah.
all over the US.
Okay, DC, and I buy then this attribute, and even though I use the gray asphalt, I say I can then, in my carbon accounting, claim that I used green asphalt. And then the person that actually buys the green asphalt would actually just buy the gray asphalt. But he would pay a much lower price, the normal price of this gray asphalt.
Yeah.
So this is environmental attribute certificates. And Tim, you told me that you have thought about, you have not issued them, but you have thought about it. It's also a topic that really just got a lot of steam a year and a half ago. So it's very recent, but you've thought about it actually. So can you tell me a little bit about
we've
it?
talked about it. It's really interesting. Understanding the scope 1 and 2 and 3 emissions. Raise your hand if you understand like scope 1, 2, and 3. All right, so most people understand the difference.
Yeah, I think there were some. So scope 1 emissions are direct emissions in what happens in the own factory, for example, of the company. And scope 2 and scope 3 emissions are indirect emissions. So scope 3 is mostly supply chain emissions. So if you say scope 3, we mean actually supply chain at the moment.
So scope 1 might be your gasoline truck that drives around it, and scope 2 might be the electric bill to power your office, right? And then scope 3 is everything else. And most companies claim that 90% of emissions come from scope 3, right? So when you talk about, let's decarbonize from within, well, yes, that's a great idea, and that's, the top 10%. That's your scope 1 and 2 emissions, and if you, are able to abate 50% of them, then you went from, that's 10% down to 5%. Great job, but you still have all of your scope 3, and all companies claim that is the hardest sector to abate. It's hard to offset your scope 3. It's also hard to track your scope 3, right? You need all of your suppliers to report their emissions to you so that you can fully understand it. Carbon offsets and EACs are a great way to come in and try to minimize your scope 3. EACs are really interesting. A lot of what we're doing right now are with carbon registries. We talked about Vera. They're the biggest carbon registry. There's dozens of carbon registries. There's probably a top 10 list that we could say, such as the gold standard and CAR, which is Carbon Action Reserve, and several other ones, Puro Earth. There's isometrics. There's some that specialize in removals, some that specialize in avoidance. But these are the ones that carry the methodologies. You submit the projects to the registry. They match it to the methodology. They check all the boxes and say, yes, your project met all the criteria. It then goes to a third party. They validate and verify it. It comes back to the registry, and the registry issues the carbon credit. So just to be clear, in case anybody didn't understand that process. EACs are essentially a booking claim system where, as when we've gotten into it, we talk to a lot of AI companies who are using blockchain technology to really book and claim this environmental attribute. And you can essentially bypass the registry, and this is more of like a tokenized credit. So you can imagine in the challenges of the carbon markets and what we've been through the last years, where when you start talking about blockchain and tokenizing the credit, there's either your skeptics, right, who don't look favorably upon cryptocurrency and blockchain technology, or some people who say, hey, I love this because it's more bulletproof, right? You can't double claim on a blockchain book and claim EAC. But there's definitely value there. There's definitely been a lot of talk of it, and I would encourage some of you guys who this sounds interesting to dive into it. We actually worked with some Harvard students on, I didn't even tell you about this, but on a study. This probably goes back about 6 or 8 months ago, where we actually had them develop what looks like a booking claim system for the carbon market. It was a really fascinating project. We worked with them for probably about 6 months on it, and it was similar to this. So, I think that there is a way right now to to crack the code and figure out how do we bypass all of these different registries and all these different methodologies and more commoditize this with, just a more simple EAC, an environmental attribute credit. It's worth 1 ton, and it can be used and not double counted by anybody. But nobody's figured it out yet, so.
Good, great. I invite you to actually read on it because I think it's, the FT wrote a great article for the first time they wrote about EACs, and that was 3 weeks ago by Simon Bundy in his newsletter. So I invite you to read this. Okay, now we're coming up to the questions part. But yeah, can we actually, but before we do that, one short answer from both of you. And Evan, you can start. What's one assumption you're making about how this market develops that you hope is right, but aren't certain about?
2030 needs to be a big year. Most large corporates, their net zero plans have a 2030 milestone for X% of decarbonization or their progress toward net zero. We have seen under the current administration some companies reneging or delaying their net zero commitments, and that has massive impacts on the carbon market, right? If you're not under the same time pressure, then there's no rush. I'll do it next year, right? So I think the assumption is that a critical mass of heavy emitters and large-scale market participants will stick to their net zero goals and make good on their prior commitments for the 2030 milestones. And I think that'll become clear in the next couple of years.
Great. Tim?
Yeah, an assumption, and I live this day to day, an assumption, I'll say a dream that I have is that the buyer, the corporate, will consistently reward quality over price. Okay, it takes a certain amount of dollars, there's economics behind the capital cost of the equipment, for example, to recycle the roadway, but this goes broadly across all carbon projects. There's a cost to do this project, and you do some math, and you realize what the price of the carbon is. And that's where you reward high quality. This is a good project. It has a lot of merit to it. The carbon accounting is correct. And, the high quality projects constitute a higher carbon price. And you would think that, hey, this is a great project. You see the research, you see the rigor, but then corporates still come in and negotiate that carbon price when we sell directly, right? So they still come in and they want it for less. And it's just this mentality that, we need the highest possible carbon credit purchase for the lowest possible price. And we understand your project is higher quality. We appreciate that. But oh, by the way, we found one that's $3 cheaper per ton. And, you lost in the RFP. We're not going to back that project for the next 2 years. We're picking another one. And when you say, what is the reason? They say it came down to price. And, the market really can't survive like that. That's not the way the game is played. Quality needs to be looked at more favorably than price. So I hope that I'm wrong. And I hope that, or maybe I hope that I'm right. I hope that I'm right, that quality will be looked upon over price. I hope that I'm not wrong.
Okay, great. Thank you.
Okay, so the first question is, there are inherent equity concerns with offset emissions. How do we ensure local environmental justice for point source emissions while advancing net zero goals?
You want to take that one?
Can you say that again?
There are inherent equity concerns with offset emissions. How do we ensure local...
Equity concerns.
Yep. So
Equity?
Equity. So how do you ensure local regions where the emissions are still being emitted while people are focusing on other regions, for example, from where they are buying these offsets? So how do you ensure the local get environmental justice?
Yeah.
Equity, okay, yeah.
Yeah, local equity.
I thought about local equity. Okay, I get it.
Yeah. Yeah, one of the ways that you look at the quality of the project is the co-benefit. So, how does it affect the society around it? And it is important. I think it's part of some of the scrutiny in the carbon market, in the early 2020s was that, the money that was raised in a carbon project, this goes to a lot of the nature-based projects, I think too, in maybe third world countries or impoverished areas, and they raise tens of millions of dollars with this carbon project, but it did not positively affect the community. In fact, some of the tracing said that not much of that money went back into the community that's sacrificed and for the carbon project. So I think that is improving. I think that it's improved greatly in the last 2 years with MRV systems, what are monitor, reporting, and verification. The standards are changing a lot right now, a lot of digital monitoring, and that, the carbon accounting as well, along with the monitoring, reporting, and verification, the carbon accounting is being scrutinized and looked at much more closely, and ultimately the buyer needs to ask the question, if I invest 10 million into this project, show me how this money gets back to the community that suffered for this project or did the work or had local people do this work. So yeah, I think a lot of it, the buyer has to demand that it's transparent and they can see where the carbon money went and how it did help the community.
I think part of the question is also talking about when you're buying these credits from outside, from a different region, but you're not making changes in the region that you were actually operating in. So what about that?
Companies tend to like to source credits geographically. So our credits in particular, I mentioned we do work in 24 of the 50 US states. And if a buyer can recognize that the work was done in their state, for us, we're rebuilding roads. So if we can say you transport your products on the roads that we have rebuilt, they can really see the tie to their value chain. And I do think that's important. From a macro level perspective, climate change is a global commodity, right? So technically, if we can save emissions here, it helps out, the other half of the hemisphere, north, south, and everywhere around. So from the right macro perspective, we should recognize that, no matter where you buy it from, it's helping the world, and we all live in this same planet Earth. But I do think that corporates are still looking for a way to tie it closer to their value chain, feel like they have more impact. So it's hard for a US-based company with US operations to buy a project in Zimbabwe where they don't do any business at all. But I would say still, if they believe that it's a high-quality project and that it truly has a lot of impact, most of them will still do it. Yeah, does that help answer the question a little bit?
I would just add, I think too, there are some projects that are just inherently, we have US buyers, for example, that gender equality is a very important value in their business model. In the US, we're fortunate that, we don't have a lot of women that are cutting down local biomass to cook dinners for their family, breathing in the fumes. They can't work because they don't have time because of the length of that process. In India, for example, we have a project in India where we basically, the developer, it's a microfinance model where they have empowered local female entrepreneurs. So they're not just giving out these cleaner cook stoves. They are actually hiring local women in these communities who have been cooking with kerosene or other dirty fuel or deforesting biomass to feed these stoves. They're actually employing these women, and they are embedded in the business. So when you talk about sort of like the durability of the business, and the term is carbon colonialism. So like when it's a US-based company that's just making profit off the backs of a supposed benefit to a local community. The most durable projects I've seen have dealt with it by really getting community buy-in to the point where it's not just the community is okay with it, but they have a vested interest in the continued success of the project. So to me, I think that's when we look at projects that are in developing countries, that's a non-negotiable.
I think we have time for only one more question, and then we'll give you time to give closing remarks. How does Microsoft's partial departure from the carbon removal market impact the projections for carbon markets?
I can start if you'd like.
Yeah.
Briefly. So Microsoft has been out in front on their own in terms of CDR. So carbon removal, carbon dioxide removal, they have been far and away the largest buyer and the largest off-taker. They're underwriting, they have been underwriting, I think it's like 80% or something, 75 or 80% of the removal purchase commitments in the last 5 years have been Microsoft.
And just so that you know, and in the carbon offset space, in the last 2 weeks, that was probably the most discussed topic. I think it was really hard for me to open LinkedIn without seeing every second post on that question.
And the reality is they were underwriting very novel, unproven carbon removal technologies that, that some of them will scale, hopefully. Some of them are science experiments and they'll fail, right? And so you can't really fault them for pushing pause or slowing their roll because they have deployed more capital than anybody into the R&D of carbon removal. I would also say that they make up about 25% of the total voluntary market. So today, removals get most of the press. Avoidance tons by retirement make up 75% of the market. And Microsoft of the total market is 25%. So they're sort of the loudest headline buyer, but there continue to be heavy emitters that are not really publishing, like Shell, for example. They have historically been, by volume, by far the largest buyer of carbon credits in the world. So I think that the announcement, it's another sort of necessary growing pain of this market where you can't build a durable, long-term scalable market with a single large buyer. And I think that this is necessary to sort of say who else is going to step up, what business models from the developer side are real that are not just banking on a single buyer for the continuation of their business. And I think that it'll be short-term painful, but sort of like the growing pains of years prior, probably a net benefit to the market in the long term.
Yeah, I'll agree. It's been all over social media. So I think we are not surprised by this question. I've talked to other people about it. Microsoft is paying by far the highest dollars per credit. We're talking $300 to $500 for some of these removal credits, experimenting with DAC, which is direct air capture, other removal technologies. They're fully aware that they're science experiments, and they're doing this for the good of the world. I believe that also they're not suspending future. They still have all of their contracts in place. I believe that they're pausing on investing in new projects at the moment. But the price of carbon at $300 to $500 for some of these experimental new technologies is not a sustainable way to go about this. Because other corporates are not as wealthy as Microsoft, right? And we still want them to buy credits, and they could never pay $300, $400, $500 per credit. You're talking, one of the most successful companies in the world. So ultimately, I think what we see is that it's okay for Microsoft to do this. They've done some of the hard work at the beginning. They're taking a pause right now, and it's time for others to step up. And it's also time for some of these technologies, after they've had the backing from Microsoft, to scale and to prove concept, to get the price down, where they can build these facilities that pull carbon out of the atmosphere, or bury it into the ground, or sequester it into concrete, or put it into roadways, into asphalt. And you can't be doing it for $300, $400 a ton because you're not going to have enough backing. Whereas, can we crack the code to get the highest quality removals, the stuff that has the most impact, and can we do it below $100 a ton? I wonder that. Our technology, where we're looking to put construction-grade biochar into asphalt at a large scale, our goal is to get that done around that marker. It might be a little above 100 for right now, but again, with scale comes more offtake of the biochar. It makes all of the business costs less, and all of a sudden, we should be able to start doing this for $80 a ton, $90 a ton. And that's where we're going to have lots of corporates stepping in and saying, you know what, at that price for a super high quality, impactful project, yeah, we can step in and we can get a lot of bang for our buck. So, you know, ultimately all of these things that happen in the market, there's reasons, and, you know, I think there's a lot of good behind them. But yeah, Microsoft has done a great way of leading innovation that would nowhere be where it is today, where they'd not have been, you know, the early ones to say, hey, I'm going to pony up, and we're going to put up the capital to let this play out.
We would just close with final remarks from each of our panelists.
Yeah, I'll start. I'll just say, you know, being here the last 2 days, I come from the project development side. You guys are the future. You know, one of the most difficult things that I find is trying to get the current level of decision makers. I think we called them jokingly the boomers, right? The boomers, and when all those words were flying up on the screen, you know, maybe this is your parents or your grandparents, making decisions today that are going to affect greatly the world in 20 to 30 years, and them knowing that why should they sacrifice right now today for something that they won't feel the impact of. And it is so hard, and it bothers me every single day. But that's where I come here and I see you guys, I see the future, I see this innovation, these ideas, the passion that you guys have. You know, when you get upset and you get mad and you say, hey, this is my world that I'm inheriting, this is the children that I want to have, and we have got to fix climate change now, and we got to fix it by 2050 or the ramifications are terrible. So, you know, I would just encourage everybody to keep your foot on the throttle. Don't be quiet. Talk about it. Innovate. Find the companies that are at the forefront of this, that are pushing cleaner technologies, and work for them, and come up with solutions. And, you know, I think I have hope when I see this generation and the passion and the young, and it helps my, at times, feeling cynical in my day-to-day business, where I feel like I'm getting decisions from people who are not impacted by cleaner technologies, because, you know, we can't fix this in the next 5, 6 years. It takes time to scale these cleaner technologies and to prove them out. So that's my closing remarks. Pass it to you.
Nice. Yeah, like I said, you know, I was in your seat not too long ago, and for better or worse, decided to join the carbon markets, and it's been a rocky ride, right? I sort of joined at the peak and wrote it down, and now, again, we're seeing these green shoots, and I think, you know, I talked to some of my peers from Kellogg who just happened to go into AI at that time, right? And like, we're in slightly different places. But I think that you know, I think that there's really something that you can't replace in working on a market-based mechanism like this that has such massive potential to scale, that if it's designed and implemented correctly, and we can get more smart young people, you know, that come from MIT and these other top institutions, like it can work, right? Like, carbon pricing is, if there is a silver bullet to me, to climate change, it is carbon pricing at scale. And I think if we can get bright minds working on that, it's a really noble problem to solve. So I invite you. It won't be easy, but anybody that's interested in this market, you know, we could use the help.
Thank you for the organizers to have me here and to moderate the panel. Thank you for the 2 panelists. I learned a lot. I really value and really enjoyed your perspectives. And I hope that you also enjoyed their perspectives, and hopefully it gave you new ideas, and you will take them with you, and you will, and hopefully it will influence you in at least a little bit. Thank you.